It's up. Okay, we're up. Alrighty. This is the LEAPS presentation. I'm going to, Doug, do you think leave it like this or switch it to this mode? Because I will have to go back and forth, which means I'll have to switch it.
Hey, John.
Yeah.
Yeah, do the larger mode just so it's easier to see. Even if you have to switch it back and forth, just do you have to go back and forth to your platform
on slides
or something?
Let me see. Yeah. So I don't know. Okay.
Yeah,
we'll
you
go
have
with
to
this
be
and
able
I'll
to
see.
really see it and deal. Yeah.
Okay.
It'll get the best recording.
Okay. Alrighty. And we will commence the presentation on LEAPS, long-term equity anticipation securities with synthetic buy rights. So LEAPS, and I'll take those dots out, and SBY, and I'll take those dots out. Here's the disclaimer. This is strictly a training program. If you enter these strategies, you can lose your shirt. So it's risky. Be advised, and please consult with a financial advisor or registered broker. I am neither, before you actually attempt to risk your baby food money or whatever. Okay, LEAPS definition. Why LEAPS? This is an outline of what we'll be doing. When do LEAPS work best? How to take profits on LEAPS, and I'll stay with AutoZone as my primary example through the whole presentation. If you want to look at AutoZone on your own charts, you might want to reference those. If you have questions during the presentation, I'm probably going to shoot through. I would think that it would be best if you put your question in as you thought of it, and then I can go back over the list and see what your question was, and we can get a good flow from there, and then you won't forget to put your question in later. That would be just an idea off the top of my head. Or write down your questions on a piece of paper rather than putting them on the chat, and then when we're done, put them in that way. Synthetic buy rights, why to do them, and then 3 methods of incorporating them, and then repair strategies for LEAPS and synthetic buy rights. Long-term equity anticipation securities. LEAPS are simply call or put options that have anywhere from 1 or 2 years to run until expiration. You're used to dealing with calls and puts in the current month, and the date we're at right now is what, the 26th, 27th of April, 26th, and so we're working April weeklies and May options, maybe talking a little bit about June, but we can go out as far right now as January 2013 or January 2014. They're an excellent substitute strategy for buying growth stocks at a huge discount. There is your advantage. You can control 100 shares of stock without having to buy 100 shares of stock. And if you find the candidates that I'd recommend, you can potentially double your money every 12 months or less, which, of course, if you work that over 12 months, works out to an 8% or better rate of return. You don't get rich quick, but some of these do move rather rapidly and can double in as little as 2 or 3 months. Where do you look for them? Growth stocks are an excellent category. There are any number of newsletters out there that focus on growth stocks that you could subscribe to those and find them. I have a list that I'll be presenting at the end of this presentation of current ones that we're in. And then when the stock market is in an uptrend, that is an excellent time to find stocks that are moving in a nice manner and fashion. And then generally the fourth year of a presidential election cycle is also a great time. Of the last 15 fourth-year presidential cycles, 89% of them have been positive. You stand a 89% probability of winning during a presidential election year. The politicians in office want to be reelected, and they will do anything they can to make sure that there's money in their constituents' pockets at vote time so that they can get reelected. And they're very good at this because 99% of all politicians get reelected. It's always the other guy's politicians, the bad guy that needs to be kicked out. Happy voters will reelect them, and no question about that. So the politicians and the Fed, the monetary arm of the government, will pump money into the economy at an accelerated rate. Doesn't mean we disagree or agree about what they're doing, but we want to find where the trade is, and LEAP strategy has proven very successful with this. We're currently in the year 2012 with this presentation. It is the fourth year of an election cycle, and just as proof evident, the first quarter of this year set a record for growth in the stock market in the last 12 to 14 years. Excellent. And the other times when the VIX works, the LEAPs work best, is when the VIX is under 20. It becomes very difficult when the VIX is under 20 to trade credit spreads, which is what we really like to do, which will give us 3 to 6% return per month. But when the VIX goes under 20, the premium in the options becomes very low. It becomes very difficult to put on a credit spread and find that 3%, but at the same time, the long-term options, January 2013, January 2014, become very inexpensive, very cheap. And so you can get into them for less than 10 cents on the dollar, and if the stock is one that is a growth stock, and if the VIX is under 20, it generally means there is no fear in the market because the market place is going up, the economy is going up, and it's just that kind of environment, and stocks will go up accordingly. It's a double win-win situation. And then when the VIX is under 20, it's very difficult to do credit spreads. You have to get very close to the underlying stock price. Any surprise economic news announcements or any world event or any earnings that are negative, and the market will just drop like a brick, and you get hurt very quickly with credit spreads. So profits become a lot quicker and a lot higher probability with the LEAPs trade. I generally recommend entering a LEAPs position at around a 60 delta. And we'll have an example of that here in just a second, so you'll be able to look at that. And I recommend finding a expiration date that's about a year out. Right now, I am split between January 2013 and January 2014 LEAPs, and I'll look at that here in a little bit later towards the end of the presentation, so you'll see why you would be in the 13s or why you would be in the 2014. They're more expensive at 2014, so it really needs to pay for itself for you to go out and buy that extra 12 months worth of potential LEAPs profitability. Once the LEAP moves from a 60 delta to an 80 delta, general rule of thumb is whatever your entry price was, it will double by an 80 delta. So you will have doubled your money. You put in $1,000 at a 60 delta. It will be worth around $2,000 at an 80 delta. I'd like to keep, if all other requirements are still in place. This is a growth stock. This is the fourth year of the election cycle. The VIX is under 20. The market's in an uptrend. Then rather than take the whole trade off the table and say, well, that was good, I made 100% return, I will roll my 80 delta LEAP, which is worth $2,000, back to the 60 delta LEAP, So I will take, which is now, still cost $1,000. So I've taken $1,000 off the table. I've taken my capital off the table, and now I am trading with the market's money, with the house money. And if I roll from 60 to 80 to 80 to 60, back and forth, I'm playing with the house money. It's no longer my money. My capital is protected. And the first objective of any trading plan should be, don't lose your money. Preserve capital. And that's why I will recommend doing that. So let's look at AutoZone. Back around the 14th of April, AutoZone was around $380 a share. So if you bought 100 shares of AutoZone, that would have cost you $38,000. Simple enough. We're going to take a look at a slide here next, so you'll see this. January of 2013, 370 call option at a 60 delta was going for around $3,300. So you could get control of 100 shares of AutoZone for around 1/11 of what it would cost, about 8.67 cents for every dollar that you would have spent buying pure shares, stock of AutoZone with straight cash. So you could have ended up buying a lot more of these. So let's look at AutoZone, and I've updated the slide to the 25th. And price is around 380. It's 382.83, close enough for military. And although we don't have an exact 60 delta, we are at 0.62 delta right here. This is a delta, okay? And although this is subdued to gray here, the January 2013 370 call is selling for a bid of around $32.70 and an ask of $33.40. So if you split the difference here, you wind up with $33.10, or about $33,000, or about $3,310 to buy one Leap that would control 100 shares of stock, as opposed to if you bought 100 shares of stock, it would cost you around $38,000. So you could get up to 11 contracts here and have 11 times what your money would have bought you just to go buy pure shares. Well, so what's the advantage of this? Well, of the 11 contracts, it's the same money as 100 shares of AutoZone. If you owned 100 shares of AutoZone, if you had two separate piles of money, $38,000 on the left side, $38,000 on the right side, you bought shares of stock of AutoZone on the left side, if the price of AutoZone goes up a dollar, you'd have 100 shares, you'd gain $100. If you owned 11 contracts of AutoZone in the January 2013 Leap at the 60 delta, you would gain $660. And your delta would increase as the price of the stock increased. Let's take a look at this in the math. 100 shares, $38,000. Stock rises to $381. You make a $100 profit. Not bad. I mean, woo-woo, that's a great thing. As opposed to if you use the same amount of money at the 60 delta for $3,310, slight adjustment there, you would spend $36,300. If the price of the stock went up a dollar, you'd have 11 contracts times the 60 delta, or you'd have a value of $36,960, or a $660 profit. This is the power of Leaps and what it can do for you, and how you can make your money work harder rather than you work harder for your money. Your money should work hard for you. You should not have to work hard for your money. So let's go back and look at past occurrence here for AutoZone. And I'm going to show you a slide of 4th of January when AutoZone was around 318 a share. And then we're going to move forward to the 5th of March when AutoZone had increased to $385 a share. And you'll see that we'd achieved a 100% return on our money in the 320 call leap in about 2 months. And the resulting delta was around N83, and we had doubled in value to about $7,500. And AutoZone will have increased about $67 to do this. So in AutoZone on the 4th of January of 2012, the 320 January 2013 leap was around a 60 delta, and it was around $3,500, a little bit more than that, $3,550, something like that, $3,550. Okay, so there you buy in about $3,500. It was selling at that time for a little bit more than 10 cents on the dollar. You'd only been able to buy 9 of these rather than the 11 in the current sample. They've gotten cheaper. But you got to remember that the VIX back in January was a lot higher than the VIX is right now. That's an advantage that the lower VIX affords you in that these premiums become cheaper. So then we move ahead to the 5th of March. Okay, the price of the stock has gone up, and the 320 leap now is worth around $7,500. Okay, we got in around the 3,500, and we then doubled our money, and it's a 0.83 delta when it went up. So we went from a 62 to an 83, or 59 delta to an 83, and we doubled our money. Okay, and it took from the 4th of January to the 5th of March to do that. It took 2 months to double your money. So that's what the power of leaps will do. If you find a stock that's a good growth story and it's moving up, then you've got it. Now, the synthetic buy right. Well, if you own 100 shares of stock, if you've ever owned 100 shares of stock, and you have rented out or sold that stock, it's listed as a strategy called a covered call. So you can sell front month, back month, call against your 100 shares of stock. You're renting out a house. Your stock represents a house that you own, and if you don't live in the house, you'll rent out the house to someone. So if you own 100 shares of stock, they're willing to let you rent that stock out and collect a premium. Well, a leap is a substitute for owning 100 shares of stock. And you can, since you're controlling 100 shares of stock, you can also rent that leap out. And rather than call it a covered call, because that's what 100 shares of stock and renting out 100 shares of stock is called, when you have a leap and rent out a leap, they call it a synthetic buy right. Okay? So you're renting it out. So one leap equivalent to owning 100 shares of stock. Covered call is to rent out 100 shares by selling one call. Synthetic buy right is selling that call against the leap, front month, back month, however you want to do it. And the added premium profit to the strategy can be as much as 6% per month. With the leap expiration, if the synthetic buyer will pay for the next year, buy further out on the leap. I think I got this slide a little bit out of place, 2 years out. Let's measure the move in the example here in how to place your synthetic buy rate. Okay, where are you going to do this at? Method one, there are 3 methods. All right, method one is measure the last 12-month move. So we're going to look at AutoZone from 2011 to 2012. 8 months ago, it was as low as 266, and in that time, it moved up to 386. all right? And so if you divide that, you wind up with about $15 a month. So here is the last 1, 2, 3, 4, 5, 6, 7, 8 months of AutoZone. 8.5 months, 8.5 months. And this will take us back to August of last year. Okay, August of last year, we were at a low of 266. And as of April, we were up around 386. It's a $120 move. Okay, that was a $120 move. And AutoZone will double in the LEAP premium about every $50, $55. So this 8.5, 9-month period of time represents not only where you would place a synthetic buy right, but also the fact this is the kind of chart and stock you're looking for your LEAP candidate. What I have on here are regression channels, okay? And the mean regression is the center purple line, and then the green lines are approximately 1 standard deviation, if you understand the bell curve, okay? And then the outer line here is around a little bit more than 2 standard deviations, up around 90%. 90% of the time, your stock is not going to exceed the regression channel. The light blue line here that you're seeing is the 50-day moving average. The dark, heavy purple line underneath this regression channel is the 200-day moving average. So if you're looking for a stock that you think, is this a candidate for a LEAPS strategy, you want to find a stock that the low of the year is 9 months or greater, preferably 12 months ago, okay? And the high of the year is within the last 30 days. And that's what we have here in this candidate. And if you can find it, the best of the best is where your 200-day moving average is below your regression channel. This is a very, very strong stock. Look at the opens and closes here. They are very tight. And although this stock has moved and actually touched the bottom of the regression channel, for the lion's share of the year, it has moved along the mean regression, the 0 line, and had a very nice upslope to it, and for the most part has remained above its 50-day moving average. So that's the strength of it. But for purposes of a synthetic buy right, you're looking here at a stock in 9 months that has moved from 266 to 286. So in AutoZone, with about a $15 move per month over that time, you would then come in here and add it to the last price of the stock, which is 382 plus 15 is 397. And you would go into the option chain. Here is May of this year. Look for something that is outside of 397, and that would be the 400. May call. Okay, this is the call side here. It's a little light. I like to see between a 15 and 20 delta, and you'll see that in a second in my example. But this will pay you between $85 and $95 a month. Obviously, we're a couple of days here into the May option chain. So the difference between 85 and 95 would be 90. This would pay you $90 a month. A few days ago, it might have paid you a little bit more than that. So $90 to $100 a month is what AutoZone is going to pay you on a synthetic buy right, while that LEAP is sitting there and gaining in value and AutoZone is moving up. You are also renting it out and bringing in some more money. So slides are out of sync with my voice. I'm sorry. I'm trying to move slowly as I can. I'll try and purposely try and move a little bit slower. As we go through the May option month, this will decay down to 0 as this price increases. The goal here is that once we reach the end of the May option month, this will decay to 0. This premium will collect that $90, the price will remain under 400, and then you will open up the June call and sell it short and collect another $90, month after month after month after month. And you will collect from the price of the stock going up as well. So you'd sell that May call around $90, you'd sell the June call around $90, and then the July call around $90. You just keep repeating that month after month after month. Method number 2, use the 10-day trading average true range, and double it. In this case, which you'll see a slide here in a second, AutoZone 10-day average true range is around $5.35. If you double that, it's what, around $10.70, and I'd put double down here 12. That has to be corrected, but so you'd be looking for something that's about $10.70 above the current price. Here is the average true range at 5 on a 10-day moving average, and this is trading days. Now the trading days in a month, in an average 30-day month, are 22 days. Take a 30-day month, take the weekends out, 4 weekends, 8 days, you wind up with about 22 days. So this will be $5.34, $5.35 doubled, and then a little bit more. So $10.70, $11, maybe $12, maybe, so somewhere between $11 and $12. And once again, if you add $11 to $12 to this, you come up with $3.93, $3.95, and then you would go to the strike that would keep you from going intrinsic, which once again, this settles in on the $400 May. You collect the $90. In June, you collect the $90. In July, you collect, so on and so forth as you go through. So you sell the May for $90 and you repeat, same as before. Now, the final one that pretty much works out as an eyeball figure, you'll notice that the previous 2 examples worked out around a 15 delta. It can go as high as a 20 delta, so a lot of times not only will I just look at a 15 to 20 delta and select that, I will also go back and do the math and say, okay, over the last 12 months, what's been the price move, or 9 months, or whatever the price move is, wherever my low for the year, 52-week, is, or the high, 52-week is. Measure that difference, divide it by 12 or 9 or whatever the months are that I'm measuring, come up with that figure, and there, where my most discouraging number is, the largest number is, that's what I'll do. I'll move it there. So a 15 to 20 delta, whichever is greater. And in this works out to be the 400 again. 31 is too high. 13 is a little low, but whatever keeps me from going intrinsic during the month. In other words, this is moving an average of $10 to $15 a month based on the first 2 methods. And the third method, if I can get between the 15 and 20 delta, that's where I'll place it and take my premium. If my choice is a 31 delta or a 13 delta, I'm going with the 13. I'll take less, because if I go with a 31, there is a high probability that I will be forced to roll this away if I go intrinsic during the month. If this price rises and goes above 390, then I will have to stay out of the money and roll it away. I'm sorry, and roll it away fast. So that is the philosophy behind the synthetic buy right, where to place it, how to use it. Why don't you want to go intrinsic? It's the same thing when you own 100 shares of stock and you sell a covered call against it. If that call goes intrinsic, they can call you away. So you have to give up the stock, you get closed out, and you have to go through all the trouble of buying back in. Well, with a leap option and with a synthetic buy right, there is a difference between the bid and the ask. And you'll have to buy in at the lowest price on the LEAP, and on the synthetic buy right, you will have to close out at the disadvantaged price as well. You don't want to do that. You want to control the in and out of this LEAP and the synthetic buy right yourself. Now, when do you move out of one synthetic buy right and into other, from one month to another month? Roll the current synthetic buy right to the next month. When the gain from the theta, the decay, that's that $90 going to 89 to 85 to 50 to 25 to 10 to 0, when that decay is greater in the next month than the current month. Right now, in this example, we're in May of 2012. The next month would be June of 2012, which is known as the back month. So the front month is May, the back month is June. So at some point, when the amount of money that we're collecting every day from the May synthetic buy right will not be as much as the money we would collect from the June synthetic buy right, we would roll to the next month. So if we look at the theoretical pricing and we select theoretical pricing and mark, on my example here is Thinkorswim, I would open this up and select theoretical pricing, and my layout would shift me to a theoretical price, a mark, a bid, and an ask. Then I have my layout set correctly. Okay? Now, let's see what this looks like for May. Okay? Price currently $382.83. I have selected the layout that gives me theoretical price, mark, bid, and ask. Okay? And the current date is the current date, the 26th of April. Remember, I was going to enter this at a May 400 call. And this is the call side over here. And I was going to get around $90. And there's my 90, my mark. And there's my theoretical price, $90. Let's go ahead one day. If we shift this theoretical price with no stock movement, one day forward, then the 400 may call, which yesterday was worth 90 cents, tomorrow will be worth 83 cents. We will capture 7 cents of profit, $7 of profit for a one-day move. And this will accelerate as we go through time all the way to expiration. So that's the May. Remember, we're going to gain 7 cents. Well, what about the June? So here's the same price, the 26th, okay? And we're looking at the June 400. Now, this is in a delta that would be way above where we want it to be. Essentially, we'd probably be rolling out to the next one, the 410, and we would have $1.67 and $1.67. Now, we go to the next day, and because AutoZone would move per month $10 to $15, I'm going to figure this around. If I was rolling to June, because I'd be further out, I'd be adding that monthly movement to this price. I'd be around the 410. And when moving ahead one day, I would gain 5 cents in decay. So for the May, I'm gaining 7 cents. For the June, I would be gaining a nickel. So clearly, I'm going to stay in the May synthetic buy right until the decay at the 410 in June will exceed what the 400 in May will make me. Remember, always make your money work harder for you. You don't work hard for your money. So if that happens halfway through the May option month, I'll roll to June. If it doesn't happen till expiration week of the May options, I'll roll during expiration week. And my experience and my history has shown that expiration week is generally when I roll all of my synthetic buy rights. Now, what do I mean by roll? A roll means that I will close May down and then open up June. And the way my broker allows that is that I can simultaneously close May and open June, or I can roll it from May to June. So that's called a roll, or a synthetic buy right roll, SBW roll. These slides got a little messed up here, so now we're back on this. Okay, and I wanted to get through the synthetic buy rights so you knew what they were before I talked about why I would be in January 2013 leap as opposed to a January 2014 leap, and we'll stick with the AutoZone example here. The cost to open a January 2014 370 call leap, and we'll have a picture here, a slide for you in a second, is going to be around $5,050. Okay? The cost to open a January 2013 370 call leap is $3,305. Excuse me. So the extra cost to be in January of 2014 is going to be $1,745. That's how much more it's going to cost you to go out to 2014 to get another 12 months of potential leap and roll. The premium, remember our premium from our monthly synthetic buy right is around $90. Now, if you do that for 12 months, that will bring in $1,080. Okay? That'll bring in $1,080. If it costs you $1,700 and change to go out and get a 2014, more than it would cost you to say in 2013, and you can only bring in $1,000, a little over $1,000, from doing the synthetic buy right, it is more cost effective to stay in 2013. Now, as we go further along, the cost of the January 2014 leaps will come down, as will the price of these. But eventually, it will be to your advantage to roll from a 2013 leap to a 2014 leap and buy that extra 12 months. When your synthetic buy right will pay for that, that's when I will roll from 2013 to 2014. Until then, I'll stay with the January 13 leap. And then again, the only reason I would roll out also to a 2014 is the growth story on AutoZone still valid? Okay? Are we still in an election year cycle? Is the stock right for the economy? What is AutoZone? It's auto parts and repairs. Right now, people are holding onto their cars a record length of time, which means they're using parts to keep the cars functioning, which means that stores like AutoZone, Advanced Auto Parts, O'Reilly Automotive, that whole sector is going to do well. So that story is continuing, and I will stay with AutoZone. I have been in AutoZone since $100 a share. You can do the math to figure out how many times, since we're up at $382 a share, how many times I have rolled my leap off the table at 100% profit. So you have the picture here of AutoZone, and this is the January 13. This is the $3,300. We've seen this slide before. Here is the January 2014 leap, okay, and a 61 Delta, where I recommend getting in. And the price, the bid here is $49. The ask is $52. A $3 or a $300 for 100 shares bid ask spread, okay? And if you were to buy this right now, you could at best probably get in around $50.50 or $5,050 is what it would cost you to get in. And so they are charging you about 12 to 13 cents on the dollar, as opposed to the 8 to 9 cents on the dollar they're charging you for the January 2013 leaps. And that difference there will speak for itself. And then if you can't generate enough cash with the synthetic buy rate every month to pay for this extra cost, stay in the 2013s until you can justify it. So, and then there is the May synthetic buy rate at the 13 delta, around $90. So a few days ago we might have gotten 95 or 100. So $1,000, $1,200 a year, not bad. If you're paying $3,000 for the leap and you're generating $1,200, you're getting a 3 or 4% return per month added on to the return you're getting from your leap, and it's just icing on the cake. The cake is the leap, the synthetic buy rate is the icing. It's a beautiful picture. So now, that's what you get when everything goes right. What if something goes wrong? What do you do? Let's say that you own the leap and there's a drop in the price of the underlying. AutoZone goes from $382 down. Okay? My first recommendation is that if we bought in a 60 delta, at a 50 delta, if it's still going down, and there's got to be reasons for that, I'm gone. Or if it hasn't violated its 50-day moving average in months and it suddenly violates it and it's going down, I'm gone. And then if you own a leap and you own a synthetic buy right, then the underlying price drops, as in the first example. I would use the premium, the $90 in the case of AutoZone, from the synthetic buy rate to go out and buy a protective put a couple of months out, whatever $90 will buy me, or slightly more. And if in other words, if I want to stay with this stock, I think the story is still valid. I think this is a momentary glitch in the movement of the stock. I'm willing to hang in there with it. Then I'll use my premium for my synthetic buy right to buy me time and buy me protection. That's a decision that has to be made based on what's going on in the economy, what's going on with that stock, and what's going on in the stock market. Now, that's if something goes wrong. What if that calculation we did on AutoZone, where it moves $10 to $15 a month, what if one month it moves faster? Because AutoZone has been up and down that regression channel in the bottom half and then the top half, moving faster than the average. If it moves faster than the average and the synthetic buy right is in danger of going intrinsic, in other words, it's in danger of going past a 50 delta, or it's in danger of going in the money, then you want to roll that synthetic buy rate out of the money. It's at 382 right now. If your synthetic buy rate was at 380, you would be intrinsic. What would you do? You would go from a 380 to a 390 synthetic buy rate and roll out of the money. Will it cost you something? Yes, it will. You're about $2 intrinsic, so it's going to cost you about $2 worth of premium to do that. Now, at the same time that your synthetic buy rate is moving up too quickly, your leap is also moving up. And originally, you entered your leap at around a 60 delta. As long as your synthetic buy rate is moving up that 80 delta, and as long as your leap is moving up at a 60 delta towards that 80 delta, and you entered your synthetic buy rate around a 15 to 20 delta or less, then you are maintaining a delta advantage. So every time that AutoZone moves up $1, your leap's gaining 60 to 80 cents, depending on where you are in that cycle. At the same time, your synthetic buy rate is moving up 15 to 20 cents, in our example at a 13 delta, it's moving up 13 cents. So you have a net delta advantage in the leap over the synthetic buy rate. Now, the stock goes up too quickly, and AutoZone moves from a 13 delta to a 23 to a 33 to a 43 to a 52 delta. Now you have shrunk down your advantage, and you want to put that advantage back on the table so that your leap is making you money and your synthetic buy rate is not losing you any money anymore. So make it go from there and roll further out, or roll to the next month and again roll out of the money. Some examples of leaps that were good viable candidates that showed good charts and good stocks: Apple, which has made a very nice move; Amazon, which has been doing well; AutoZone; Baidu up until yesterday's earnings; Chipotle, which has made a phenomenal move to the upside; IBM, ISRG, MasterCard, PCN, Ralph Lauren, and you can also add Visa to that list, along with a few other stocks that we have brought on recently. We have Dollar Tree, DLTR, that we've had on there; Monster, MNST, the Monster Energy Drink, has done well; O'Reilly Automotive, which has done well; a number of stocks that are moving in our favor. Regeneron, REGN, has been doing that. So the list continues to grow. So in summary, leaps, they're primarily growth stocks. And we like the bull market. We like the election year market as well, presidential election year. We look for an entry around 60 delta. And then once they reach an 80 delta, generally that will mean you have doubled your money. You have a 100% return. And I will then roll it back to a 60 delta and continue that. I look for a leap that is 1 year to 2 years out. And I marry that strategy with a synthetic buy rate to bring in extra premium. And that synthetic buy rate will also help me determine whether I want to be in a year out or 2 years out. If the synthetic buy rate will pay in premium for that second year, roll to the further year. In AutoZone right now, I'm in January 2013. In Apple and MasterCard, I'm in January of 2014, simply because the synthetic buy rate premium pays me to go out 12 more months. So in summary, can you get in a 60 delta and get out of the 70? Sure you can. But remember that $300 difference between the bid and the ask. How many times do you want to pay that difference? I like to minimize it. And doubling my money, if I find a stock that if I look at it on the chart and in the last 12 months, it has gone up in price enough to give me a double in the leap, and the chart looks like what I showed you there on AutoZone, with the regression channel going from lower left to higher right, the 200-day moving average at or below the bottom of the regression channel, and a good growth story behind the stock from various newsletters or research that you have done. And we have a VIX under 20. We have a market that is in a growth. We have in the fourth year of the presidential election cycle. It's an excellent strategy, which you can make your money work at least 8% a month with an add-on of 3 to 6% in a synthetic buy rate. You're not going to get rich quick, but you're going to have a strategy that's going to return more than any investment fund out there. So with that, I will stop the presentation and look for questions. Thank you. Okay. Let me go back up to the top slide, and then we can shift between all those as we come to the questions. Point out the risk. If the stock price doesn't move, you lose nothing. but the time value of your money. The options lose 100%, Bob. This is correct. If you have picked a stock because of the growth story, because the VIX is under 20, because it's the fourth year of a presidential election cycle, and none of these prove valid, then the only thing that's going to keep your head above water there is the synthetic buy rate. And if that won't get you 3% a month, then it's probably not working out. Right now, we've got McDonald's as an example that is struggling. It got to that $100 number. It looked like a good story, and it has fallen back into the mid-90s. And the only thing that's making a little bit of money is the synthetic buy rate, and it is a very weak candidate right now. Although the company's growth story still remains, it's not performing along with our other growth stocks, and it may be one that we may have to pull off the table. Let's see. When you say synthetic buy rate, do you mean covered call? Yes. A synthetic buy rate is just another name for a covered call. In both instances, you are selling a call against either your 100 shares of stock or against the LEAP that you own, because the LEAP represents 100 shares of stock, gives you the same rights as 100 shares of stock. Yeah, Mike, current month's just a different name, that's all. Instead of using theoretical pricing to evaluate issues, roll to cover, is there a way to compare theta for the 2 months? I've not found a better or easier way, Paul. 200-day moving average, just a simple moving average, Jose. Simple moving average. That's all. Not exponential. Same with the 50 and with the 10-day. I have them all at simple. I have nothing at exponential. And I primarily focus on the 50 and the 200-day in a lot of the strategies that I do that harken back to credit spreads. But I think you can see from, you look at any of those charts at all, and when you can see the 200-day moving average riding at the bottom of the regression channel or below it, that validates your suspicions about this is a growth, this is a LEAPS candidate. So anytime, you know, a missed method 1 for the buy rate, okay. Let me go chase that down. All right, you can add as much as 6% premium. And this slide is out of place. Here we go on method 1. So last measure. This would be AutoZone, okay? And what I'm doing is I'm taking the price movement, and this is what 266 to 388, $120 move. 120, and if I divide that by 9, I wind up with around $13. 8 months, $15. In that was the low of the year. So I then divide, you know, that to come up with a, okay, on an average, how much did it move? Well, it moved a lot more there than it did here. I mean, it actually moved down here. I mean, it was all over the sky during the month, but this month here exceeded probably the $15. This one's the 15, or less than the 15. This may have been around $10 to $15. We moved down in this month, and we moved down again. Then, you know, we shot up here, and then we moved down. The average is around 10 to 15. So will it involve some work during the month? Yes, it will. And so you're trying to capture as much premium as you possibly can with not creating too many headaches. If you get a market that's moving up most aggressively, and everything's piling on and you're constantly have to rolling your synthetic buy rights out of the money, it means your leaps are doing extremely well. But you just have to stay on top of your synthetic buy rights. What you would like, optimally, is for that $90 premium on the synthetic buy right. And let me put this on the full slide here, okay, so you maybe see a little bit better. What you would like is for this $90 worth of premium to decay to near zero as we reach expiration Friday. That's the optimum condition. And then for it to expire worthless, you hold on to your leap, and then on that next Monday, you open up the June. And if the stock price has climbed on average $10 to $15, so let's say it's $3.95, in June you'd go for the $4.10, which the premium is going to be around $90 to $100. And you would just keep doing that month after month. That's the optimum situation. Okay, missed method one, show the slide. Do you look to buy a leap near the bottom of the regression channel? Would you buy one in a strong rally? Bob, if you had your druthers, if I could go back a year and buy, I would buy near the bottom of wherever the bottom of the regression channel was. What I like, for instance, in AutoZone here, is I like to find stocks that ride as close to the mean regression line as possible, and then I'm averaging. But would I rather have bought AutoZone right here or right here at the bottom of the regression channel? Sure I would. Sure I would. When you have a stock as strong as this, and you know, the growth story is good. It's the presidential election cycle. The VIX is under 20. What all these factors are, this would be the ideal time. But as I said, I have been in this stock since $100 a share. Every $50 to $55, it doubles in value. We're up to 382, 386. So I got in at 100. I rolled once at 150, twice at 200. 3 times at 250, 3 times at 300, 4 times at 350. You know, I'm about in my 5th roll right now, and that's been since what, February of '09, if I'm correct. About 5 rolls, 4 or 5 rolls, works for me. So, and the growth story hasn't changed. What is for Apple? I mean, where are we at Apple? $600, and where are the price targets from all these different companies? As high as $1,000. That's another $400, and it's rolling about every $80. So there's another 3 or 4 rolls there. And who's to say that once we get to 1,000, they won't have a price target of 1,200, 1,300, 14, 15. The story hasn't changed for Apple. The price targets have, but remember the old price targets? They changed to the new price targets. If the story of Apple doesn't change, then what the Chipotle is at the bottom, depending on the length of your channel, right? I can move I'll move since we're through with that presentation, let me move this back over. We are slightly positive in the market. It's a nice quiet day. Chipotle, okay? Here is a stock with a low, 52-week low, a year ago at 250. And we have a high within the last 30 days. Even though we've had a pullback, we may be getting a bounce now. Okay, we finally reached the 50-day moving average, and we're bouncing up 442. That is 100, 200, and that's 190 points. Call it 190 points, 185, whichever you're happier with, whatever you're more comfortable with. 185 points. And we're down to the 50-day. It appears to be bouncing. It reached the bottom of its regression channel once, twice, 3 times, almost 4 times. This this March here was incredible. But the reason that it marched without a correction is why we're getting such a hard correction right now. They all have to pay the cash register. Somebody rings up the cash register all the time on these things. But right now, the 50-day may be holding. The story really hasn't changed on Chipotle. But again, the tight closes like AutoZone. So if we go over and look at the leap on Chipotle, we come into 2014, okay, 2013 rather, and this thing costs around, at a 60 delta, around 5,100, which is about 12 or 13 cents on the dollar. Not as cheap as AutoZone, but still anything under 20 cents, when you're getting 5 of these things, is incredible because you're multiplying your wins. And in January 2014, to get around a 60 delta, $7,500. So you're adding another $2,300, $2,500 to this to be able to go out another year. But if you go look at the May options and you look around a 15 to 20 delta, and I'm just doing a rough rule of thumb right now, only there's more ways, there's 2 or 3 other methods we can back this up with. There's around $250, $260 premium, and we're into Thursday of the first week of the month, so it could even be higher with a full month. Times 12 is $3,000. So you can bring in up to $3,000 or more worth of synthetic buy right on Chipotle, which will more than pay for half of this premium. If you simply held this thing for 12 months and take the decay out, you might realize a 3 or 4 or 5% return if it didn't move. Or you could say this stock's still going to continue to go up, and I'd like to go buy more time here. Well, $5,000, $5,100 versus just about the same thing will cost you another $2,500. Well, the synthetic buy right will pay for you to go out to 2014. That's why I'm in 2014. Now, I've taken a hit from my 60 delta. I'm at a 58 delta. So I'm down a little bit, but I rolled this before earnings to take my money off the table. That's another thing I got to add. Daggone it, I forgot. I'll add that to the presentation, in that I also recommend just before earnings that you roll any profits off the table, roll it back to around the 60 delta, so you're protected from an earnings shock. You think of things as you go through this, and then you think, oh, I should have said something about that. Oh, I should have said something about that. So now I got to make a note to myself to go back in there, restructure that one slide, and add a little section about earnings events and what I recommend doing around an earnings event. Not that you have to do it, but that it can do well. Mike has seen a double in what would you get? Where'd you get your doubles, Mike? Monster and what else? I forget. But he's had 2 doubles here and pulled about, what, $16,000 off the table? Dollar Tree and Monster. So he's pulled $16,000 off the table from a $16,000 investment. So he went from 16 to 32,000. Now he's got the market's $16,000, and you're almost a triple on O'Reilly Automotive. Good God. How many contracts on O'Reilly? 10? 10. You character, you. 10. Oh, God. Mr. 10. We're going to call him a 10, okay? From now on, Mike's known as Mr. 10. All right. Then he'll change it and go to 20 contracts on us. I swear, Mike, I do my one contract, and you're putting me to shame. Easier to do the math. Easier to do the math. So that man's moving smart. So at any rate, you've got to where Chipotle, the premium from Chipotle will pay you to roll out to 2014 if you're still convinced in the Chipotle story and you're willing to go by that extra time, have you really got 20 contracts on Dollar Tree? Very smart, Mike. I don't see that story changing. They've taken market share away from Walmart, and now Walmart's giving itself a bloody nose. So, congratulations to you. So that ought to answer the question on Chipotle. And then, what else are we in? Advanced Auto Parts. Again, same sector. Look at that chart. Now, the 200-day moving average is diving towards the bottom of the regression channel. Not as strong as AutoZone, but very impressive nonetheless. Alexion Pharmaceutical, look at the 200-day moving average. How far below the regression channel is. That's strong. You know, it just doesn't get any better. AutoZone, for the full year, you know, 200-day moving average sitting down there, moving where we want it to go. Let's see, Bed Bath & Beyond looked pretty good, not as strong. See, the 200 days near the bottom, but it's not there yet. Biogen, 200-day moving average, it's weakened a little bit, but still, look at the tight closes. Look at the movement along the regression channel here. It's just, you're not going to get rich quick, but you're going to do well. And then Chipotle we just looked at. Dollar Tree, this is why Mike Staya is going to continue to make money and continue to double his money. What's on stake about the May reversal? I'll open it up and we'll chit-chat it here in a minute. Let me get through some of these other examples and then we'll go to that. Sell in May and go away. So now when you sell in May and go away, is the story for AutoZone or Dollar Tree going to change? No, it's going to stay the same. And the funds, even though some other stocks are going to maybe go flat for the summer, these are going to continue to move up. What did it do last summer? Okay, June, July, August it had a pullback. So 2 out of 3 months it did well. Not shabby. Not interested in either one of those. Google was a play for a while. I took Google off. And ISRG. There you go. Same story. Look at the 200-day moving average. Same story. IBM, up until recently, IBM moving along the mean regression. And now we're back to it, and we're bouncing off of it and bouncing off the 50-day. The 200-day moving average is down along here. Not as strong, but very impressive. LinkedIn is just starting. And then MasterCard. Absolutely beautiful. Absolute. This one dip here, this bowl, cup handle. Look at it move along. Are people going to stop using credit cards? No. Here is a continuing story. Are you going to get as rich as quick as Monster or Dollar Tree? No, but you're going to do well. It's safer. Look at the 200-day moving average. McDonald's, this is the one that stalled on us. Look at that. Isn't that nice? And then it's gone nowhere and gone down. So, and look at the 200-day moving average. We're down to the 200-day. And it hasn't been down to the bottom of its regression channel in the last 52 weeks. So this is about ready to come off the table. I'm not going to play it much longer. Monster. Is that sweet or what? Look at those tight finishes. Look at the 200-day moving average. Get used to seeing this kind of chart. Low of the year 52 weeks ago. High for the year last 2 weeks. MO, Altria, looking good. Netflix sure isn't a candidate. PCLN of recent looked good, and now it's pulling back. $1,000 price target though. The 200-day moving average was moving down, but now it's at the 1 standard deviation. Not as strong a candidate. Polaris, best in sector. Little more choppy, but still moving up nicely and giving you that double. Panera, not as strong, but you can see from the movement of the 200-day moving average getting better. Ralph Lauren, waiting. There we go. Not as strong, had a bit of weakness, but then now it's starting to weaken again. One of our recent ones, Regeneron, very nice. Tight closes. You like these tight closes, okay? Very tight, very nice. TJ Maxx, here you go. Looky here, look at the 200-day. There it is. And this is a cheap one, $24 to $41. This has a long way to go yet. Tractor Supply, here you go. Same story. Under Armour, a little bit looser, but still a good trend. Look at the 200-day. It's not as strong, but it's there. Visa, look at the 200-day. Are people going to stop using their credit cards? No. More recent entry, VFC, sweet. Okay. Very sweet. 200-day, look at it. So that kind of takes us through the list. The Almanac, Stock Traders Almanac. Here we go for May, right? And it says May-June disaster area between 65 and 84. S&P down 15 out of 20 Mays. That was 65 to 84, long time. Between 85 and 97, May was the best month, 13 straight gains. Okay, this is all old history. This is a current book. Why are we getting old history? First trading day of May, which is next Tuesday. We've been up 11 out of the last 14 years. The Dow has finished up 11 of the last 14 years, starting next Tuesday. Okay? Not a lot of other information. Monday after Mother's Day, the Dow has been up 14 of the last 17 days. And that's also expiration week. Not only is the Monday after Mother's Day, which is also the Monday of expiration week, has the Dow been up 14 of the last 17, but the Dow on expiration Monday week of expiration week, that Monday has been up 14 of the last 24 with an average gain of 0.5%. Jose, which newsletter? IBD, Investor Business Daily, and Virtue of Selfish Investing. If you're not getting them, let me know. We can talk. The Friday before Memorial Day is on the 28th of May, down 7 of 11. Nothing about, okay, the day after Memorial Day, up 17 of the last 25. But Memorial Day week has been down more than half of the last. Expiration day in May, Dow's been down 13 of 22. Expiration Friday in May, down 13. So generally positive news about May, but they always say sell in May and go away. So it's something we'll have to keep an eye on. VFC on your leap list, yes. Yeah. Okay. So the market's been positive. We've got 5 minutes. Daggone it. Let's go see what the market's doing here. I didn't think we'd get done early. Apple's down, profit taking going on. Look at AutoZone. Okay, here's the situation. Here's the case again on AutoZone, where for some reason they received an upgrade the other day from somebody. Look at my synthetic buy rate. It has gone intrinsic. Okay. Look at my credit spread. It's in trouble. I'm going to have to pay attention to this to take care of this. So I've got to roll my synthetic buy rate out of the money. Now, if I roll the 400, I have the problem that this is now in the way. And my $15 a month average just got wiped out in one day by some kind of a news announcement. That's where these things become a headache. Now, my leap and the delta's gone to a 64 here. My leap is now at an 81 delta, and I'm ready to roll and take my money off the table. I've doubled. I've hit a double today on this, on my leap. So I got a lot of things I got to do with AutoZone right now. The credit spread is in severe trouble, so I've got a headache there. First, I'm going to roll my leap out of the money. I took a hit on this. So, because I have a problem with this, for right now I could roll this out right to here and be done with it. But then I've got to roll this out of the way, or I've got to protect it, and I can't roll my synthetic buy rate. I'll roll it one more time in May, since we have so much of the month left to go. I'll put it at the 400. If I have to roll it again, I'm going to have to either get this credit spread out of the way or roll into June, and that's going to cost me some money. They don't want to do it at $4.95, and I want to get this done, so I'm going to put it to $5. And they should take it. They took it. So that rolled out of the way, and I'm no longer intrinsic. Now, I do have to protect this, and I've got 10 contracts times a delta difference here of 20. So I would need to go buy 450 deltas in June. And so either get a bunch of these or a bunch of these. 4 of these is going to be extremely expensive. This hurts. $11 in one day. This hurts. So I will put protection on there. And then I'm also going to take my leap, which got about $2,800 worth of profit in it. And I'm going to roll it. Now, I've got to calculate here, and I just did that really. If I roll back here, it's going to be into about here, $3,400. Okay, so I really haven't got my double yet. I'm going to need a little bit more to get my double. I'll get my double around another $5 probably. I'll hit my double. Or another $10. All right, so I'll put that on the back burner for right now, because I'm going to roll into around the 60 delta right in here at the 380. So you can see from 380 at 3,400, you're getting a double about every $45 to $50 on that. Because an 81, 82 delta, whatever this is going to do for me, 83 delta, is going to get me, you know, there's 335 probably, and here's 380. So that's around $45. Every $45 I'm getting a double on this. But I'm only getting $90 on the synthetic buy rate. And to go to a 60 delta in January 14 is going to cost me $5,100 or another $1,700. And I'm only getting about $1,100 from the synthetic buy rate. So it's not to my advantage yet to roll to 2014. It's still cheaper owning the January 13 leaps than owning the January 2014s. So that's how that got calculated, type thing. Alrighty, it's 11 o'clock. Let me go see what else we got here. Apple shouldn't be any kind of a headache. The headache on AutoZone is it moved up too fast on me. And I'm going to have to, I protected the bear call, so I've got that protected. Boeing is fine. Baidu's still going down. Chipotle is sideways. Sideways, nothing here. Nothing here, still going up, making us money. FFIV's coming back, that's a good thing. Google's up $3. I think I took that one off. Granger's down another $1.70. ISRG is down. That's interesting. Close all these up. And the how about that? This still doesn't want to come off the table. That's incredible. 25 cents there, minus 5 cents there, a dime. Why? I mean, it should have been gone a long time ago. LinkedIn came off. MasterCard's up another $4 or $5. There's nothing on MasterCard. Netflix still down a little bit. McDonald's up pennies. PCLN up a few pennies. O'Reilly Automotive had a really good earnings. Went intrinsic here, so I got to roll this away. And then I think Mike said that we doubled, right? I've already taken. I rolled mine back prior to earnings, so now I'm moved up there as well. But I'm not ready to roll it again. But I do have to take this out of the money. A 78 delta. I'm losing money here right now. That is no fun whatsoever. So I've got to take this to a June 110 probably. O'Reilly. And this one's gone intrinsic. And we're going to roll this to a June. Well, it says there's a 105. Is there a 105? There is, but it's too close. To a June 110. So that one got away from me. And we'll worry about getting that rolled here in a second. See, I'm actually losing money for every dollar that O'Reilly goes up right now. I'm losing 79 cents on my synthetic buy right. I'm only gaining 72 cents on my leap. I'm losing 7 cents for every dollar that it goes up, which is not good. And that's why this has to roll. And it has to roll back down to this 20 delta to get me out of that. And it just moved again. I'm going to take care of this quickly. At least I thought it was. Man. Okay, so I'll come back to that. PCLN. I have one more to go here, and that'll disappear on the weekly. Panera's okay. The Rut's okay. All these are okay. Nothing going on there. BFC's up nice. Our synthetic buy right's okay. It is. It's a problem at 155. We have room. Otherwise, we're good. I just have to work on that AutoZone. I moved out. Look at AutoZone go. Wow. Incredible. Okay, so look at that. 435. That's why they won't play right now. This is moving like a bandit. They don't want to play. Look at that. Move to 440. Unreal. I'll move it a dime and see what happens. Oh well, let's all go get some lunch. I lost you. I lost you all. Okay, I'm sorry, everyone. I showed myself not in the room anymore. I couldn't even get the controls, and they're funky right now. So I'm going to call quits for now and release the room and put everybody back on. And